Just while everyone's filing into the room and getting the audio sorted out, I'll just give it another moment for the computers to do their thing. And for those that think there's no sound, to sort their sound out. I might just give another 30 seconds. It looks like those that are probably going to be here by 12 will be here now. Righty. Okay, I think we'll probably kick off. We have found that most people tend to join in the first few minutes, have your lunch at the same time, then shoot off from there. So, good afternoon, everybody. Some of you that know, my name's Ben Lavender. On behalf of Private Wealth Advisors, being Roger, Grant, Jack and Kerry, thank you for joining us and having a listen to the insights of Chris Tennent, who's the ASB Senior Economist. By way of brief background, Chris has been in the financial sector for over 25 years, joined the Commonwealth Bank's Global Research Team in 2005 and has worked for either CBA or ASB between here and in Sydney over that time. Prior to that, he was also in the funds management business, so also understands for some of our clients on the call today what you do and where you invest. Interestingly, Chris was a New Zealand representative in cycling, and as we're just having a chat, also holds a commercial pilot's license. So a bit of interesting activities there on the side. So in terms of the run sheet today, I will hand over to Chris shortly because no one really is here to listen to me. As you have questions, please use the questions box. I'll make sure it's working. If it's not, just fire an email through to your advisor or whoever sent it through and they'll pass it on to me, but I'll get that question working. I think we'll probably get about 20 minutes of Chris taking us through his slides and then we'll do some Q&A at the end and sort of hopefully wrap up by about 12:45. So without taking any more time, I will hand over to you, Chris.
Hey, thanks Ben, and thanks everyone for dialing in. It's good to be here to be able to chat with you, and hopefully you can see a small picture of me glowing away in my office at home, and then a larger picture of the actual presentation, which is me in my outfit that I wore during COVID to keep myself safe. We're going to kick through a few topics today. I know everyone's in the investment space, which, like Ben said, is where I started out life. I worked for the mighty Bankers Trust as one of my first jobs out of uni in the 90s. And as you can tell from my grey hair, I've been around a while. I spent a bunch of time working in farming and in retail and racing my bike overseas when I was younger. But some of the stuff I've done at either the funds management or with ASB, FX forecasting, global economic forecasting as part of the global team, and then here in New Zealand, everything from forecasting what might happen next with your mortgage rates to what price we might get for milking a cow, in terms of the milk price. So hopefully we can come across some interesting stuff and get some interesting questions along the way. So yeah, just chuck them in the chat and Ben will keep an eye on those and we'll use that at the end. Anyway, let's get on with it with a bit of macro overview, some thoughts about the change of government, inflation and interest rates, what it all means for housing and property in general, and a couple of comments on where we think investments are at. No doubt it's been a pretty tough time for your traditional balanced portfolio, and there's been a bit of ups and downs for a property, that's for sure, over the last couple of years. In terms of NZ activity, GDP is interesting, gross domestic product. I just think of this as the broadest measure of income or activity within the economy, and It's backward looking. It's always subject to a bit of seasonal adjustment and revisions. And one of the interesting things that occurred within the last GDP release was the economy's performance was revised up slightly. And so it turned out we weren't in a recession after all. I don't really get hung up on this recession word too much. From a technical perspective, it just means it's a recession if you contract for 2 quarters in a row. It doesn't matter if the economy contracts by 0.1% or 10% in terms of the definition. So when we're hovering around with low growth like we are at the moment, I think that's the key issue. Where I start to worry is when you get a humdinger of a recession, like we had in the global financial crisis, which leads to massively subdued investment, much higher unemployment rates, and weakness in other markets, rather than what we're going through now, which is a period of really slow growth. One of the important things happening now, though, is which we'll talk about, is this per capita contraction in activity we're seeing, and what's going on for households. And those are all the bad things. Then there's some positives, like tourism and the borders opening up, which are helpful. All right, let's get into it. So firstly, one of the things which is going on in the economy at the moment is this amazing level of migration flow. I pondered if I was a speechwriter for one of the Chris's on the run into the election. You could write your story either way. You could say the management of the economy has been terrible, and so's the outlook, and that's why we've got record outflows of Kiwis at the moment. And then the flip side of that same story, you could say, hey, we must be doing a lot of things right here. We've got record inflows of migrants coming into New Zealand at the moment. Both are true, and I think both really just capture these massive changes in economic patterns courtesy of COVID. You know, teenagers or people that have finished uni or whatever age group you look at, there's always a desire to travel overseas for New Zealanders, and we had 3 years where we couldn't do that. So when borders around the world open up, understandably, all of that pent-up demand from 3 years happens with a bit of a surge, and that's what we're seeing. There's a lot of Kiwis leaving for their OE, you know, sort of 12 months or more overseas, but lots of people coming into New Zealand that would have otherwise have been appearing over the last 3 years. But what's interesting is if we net that out and think how many people are crossing the border right now, it's a net inflow of around 100,000, which is absolutely massive. Now, some of the booms we've seen in the past, in terms of peaks that have really stimulated the housing market, had an impact on the labour market. We've been talking about the 40,000s, 50,000s, and here we are with a migration inflow of 100,000. So where that's visible in the economy, I think over the year ahead, it's going to be an underlying support for the housing market, and it's going to be a help for the labour market with some of the skill shortages that we've developed. Again, one of the things I reflect on when I'm sort of wrapping up on migration flows is two elections ago, you would have done well by having an anti-migrant policy. And here we are now with people going, we need the borders to open. We need people to come back in to keep the tills ringing, help the labour market, help with some of the capacity constraints that are out there. And so far, it's been pretty helpful on the wage front and the job market front to plug some of those skill shortages gaps. But normally you'd see the inflationary impacts first and the labour relief later, but it's actually been pretty helpful that those arrivals have certainly helped on the labour market front. We got the latest labour data out today, and the unemployment rate ticked up to 3.9%, but not because of mass layoffs. There's slightly less people employed now compared to a quarter ago. But a big chunk of the increase in the unemployment rate is the increase in the working age population, and in turn, that's coming through migration. Okay, but if GDP growth we're not in a recession, but it's definitely been flat, but the population's growing really, really strong. Here's the problem, is on a per capita basis, we are in a recession. If we think GDP is the broadest measure of income within the economy, and then we divide it by the population, and then that number's contracting, this is one half of the cost of living pressures that we're seeing under there, that we're not seeing strong wage growth or strong income growth into the entire economy. On an individual person basis, we're actually doing less, and that's probably going to continue for a while. So GDP per capita is a handy thing to keep an eye on in the future. And it's also a handy thing to keep an eye on when politicians are trumpeting about the great economic growth that we're getting. Well, you will get strong economic growth if you open up the borders and have a lot of people coming in. But it's that per capita GDP growth that I think is really important for things like wage growth and improvements. Okay, so what do we think in terms of the outlook if we're not in a recession now? We actually still think this weak period of growth is going to continue. There's no quick fix with a change of government or a change of policy at all. Some of these constraints are going to be around for a while, and no government's going to change some of the issues. Effective mortgage rates haven't peaked yet. The Reserve Bank put out their financial stability report today. Normally, I wouldn't say it's a good read, but if you're got investments in commercial property, you're interested in some of the things which are stressing out households, and the financial stability report has some pretty good info on that. Likewise, some pretty good info on the Reserve Bank's latest thoughts on the agricultural sector, which is another area under pressure in the economy. But the key thing is, if we look at that financial stability report, the Reserve Bank's aware that there's a lot of tightening that's still got to come through as people roll off fixed rate mortgages into these higher rates. Even with no OCR hikes going forward, there's still going to be some pain to come, regardless of who's in charge. China and our trading partner growth are still weak. There's no sort of magical turnaround in the forecast for what sort of global backdrop we're trading into. That feeds into our outlook for the export sector, of course. And the other point there, why we think growth will slow, it's great that the borders are open, and that means more tourists can come here. We're definitely seeing that. Places like Queenstown are on fire every time I've been there. But on the other hand, we are also seeing Kiwis travelling in record numbers. I, for one, have replaced my domestic travel over the last 3 years with trips to see my parents in America and my in-laws in Japan, whereas 2 or 3 years ago I would have been spending that money here. So net, the borders opening up are actually not quite as positive for the overall economy as you'd think, because Kiwis are big travellers for short-term holidays as well as those longer-term overseas experiences that we have. The other thing, which is whether we had a Labour government or a national government, we were seeing fiscal policy, so this is government expenditure, a need for it to get tightened, and that should continue. And those peak migration flows that I've talked about, over 100,000, maybe we'll see those tail off once the surge of people catching up with what they wanted to do starts to wash through the numbers, and things return to a more normal pattern. Okay, let's have a closer look at how some of that looks. I mentioned the global growth backdrop's not super supportive. We're seeing major export partners like China really struggling at the moment. Case in point, milk prices for dairy farmers, our biggest export, down to, they're going to get paid around $7 per kilo of milk solids this year. We were thinking $8 to $10 was reasonable a couple of years ago. So that's below the break even for many farmers, and not positive, not likely to turn around until things start to improve in some of those key markets. Likewise, forestry, meat, they're all not having great prices these days, in part reflecting that subdued global backdrop. Full tourism recovery still a way off. Here's the totals of where people come in from, just broken down a bit. And incidentally, I'll get Ben to share this presentation with you so you can have a closer look at some of these charts if it's helpful. But for many areas, you can see we're still well below the pre-COVID peaks. The total line also gets tossed around a bit by what Kiwis are choosing to do in terms of returns. But you can see for most areas, and China and Asia in particular, still well below the pre-pandemic peaks. And then there's that netting that I've already mentioned that flows in there. Okay, so if we look at the economy, we talk about GDP as the broadest measure of income that's coming in. What do we spend it on? Well, the bulk of our money that we earn flows back into consumption in one form or another. And so if we're having a per capita recession on a GDP basis, it's not surprising that we've got this incredibly flat outlook for consumption. So this adjusts for prices. We're still spending the same amount each week if we're still employed. It's just not going as far as it did in the past. So for us, the areas of weakness in the economy, the areas where people can do some belt tightening to deal with higher interest rates, higher fuel costs, etc. Areas like hospitality, more broadly consumption. We're seeing it in durable goods sales as well, goods that are designed to last for a couple of years or more, like your barbecue, your whiteware, etc. We're playing a bit of catch up with people spending a lot of money on that sort of stuff while the borders were closed. Don't need to have a show of hands because I can't see you, but a lot of people, including me, while we were stuck at home, did things like buy a replacement for the car, a bit of replacement for stuff around the home because that's what we could do. And those were the things we're enjoying while the borders were closed. And it's very, very easy when you're facing a bit of cost of living pressure to go, hey, those things I bought only a couple of years ago will do fine, thanks, for the next couple of years. So that's why we've got this very flat outlook for consumption over this year and next. And indeed, we're seeing that within the retail sales figures that we look at. Beyond the odd helpful boost of things like the Women's Rugby World Cup, for example, which really spurred things along for a month or so while that was going on. But on the whole, it's been pretty subdued stuff for household expenditure and consumption. The other thing which is going on in the economy, which we can't ignore, is the economy as a whole is in a savings deficit, if you like. So the balance of payments and international investment position really reflects our capital flows and financial flows with the rest of the world. If we've got a current account deficit, which we do, where we are basically importing a much greater value of goods than we're exporting, that leads to a trade deficit. Likewise, if we're doing the same on services, that leads to a services deficit, and we get this big current account deficit. Now, normally, that needs to be offset, and it is offset by capital inflows. One of the savers in the New Zealand economy over the last 20 years on the whole has been the government, with the exception of the Canterbury rebuild and the pandemic and a little bit of time in the global financial crisis. The government's typically been a saver But as we know, they haven't during the pandemic, which is the right policy response. But it all contributes to the fact that New Zealand needs a lot of money to fund this current account deficit. It's slowly getting better, but it's a factor I have in the back of my mind for what sort of interest rates might we need to pay to raise money in the world. Where's some evidence of this? New Zealand government bond yield for a 10-year, same sort of credit quality, but much higher yields than the rates that we'd see elsewhere. Now, the 10-year New Zealand government bond, for example, is higher than the US or the Australian 10-year government bond. Our mortgage rates are higher than what you'd see in Australia or the US, and our term deposit rates are as well. So this is where the stuff flows into the real economy. We'll touch on term deposits a little bit later on, and mortgage rates, because they flow into your trade-offs with things like property investments. All right, election. Everyone loves looking at it. Here's some facts and things that we think about. Surprisingly, we hardly ever change our economic forecasts when an election takes place, and that might seem surprising. But really, when we look at New Zealand, the political parties are pretty central. The likes of the Greens and ACT have sort of try and take the debate out to each end of the scale. But if you look at the Nationals' tax policies, they're not proposing anything wild like a 20% flat tax rate, or the big sort of corporate tax cuts that, say, Trump brought in America. They both believe in fiscal restraint, having debt relative to GDP, government debt that is, around 20%. But there are some changes. I think for residential property, the tax changes are friendly for property investors. Property-friendly tax changes would possibly depend on whether you're a first-home buyer or not. But for an investment class, it's a bit more helpful to be able to deduct interest. And there's clearly some changes that are going on for commercial property that were in the campaign as well. Probably a narrowing back to the RBNZ focus on inflation, just simplifying the goals there. But at the end of the day, the Reserve Bank's going to be independent. And probably targeting somewhere around 2% for its inflation target. I don't really agree with the ACT statements about where the RBNZ should be going, having worked through the 90s, when I think if you're too hard on inflation, you can run into some problems elsewhere. But nonetheless, we'll probably see some changes there, but they're not big enough for us to massively change our economic forecasts. What we do see is a bounce in business confidence, and we saw a massive lift in last month's confidence after the election. But what I'll demonstrate, hopefully, is that doesn't actually change much. There's bigger economic issues to think about. We just seem to do this. Here is a chart I've put together of general business confidence in the economy. And these line changes here are when we change from National to Labour. Now, what we can see is that businesses, when we get a political change, will always go, the economic outlook's better under a national-led government. And businesses' confidence in the overall economy has been a terrible indicator of economic activity. Partly because of this swing. Businesses' confidence in their own activity is a little bit better. And we can see in the chart on the right, I've linked that to GDP. But even then, businesses tend to be a little bit optimistic about their own activity under a national-led government, and a little bit pessimistic if there was any sort of trend in there under a Labour-led government. I think what businesses really need to worry about is skill shortages, demand issues for product, and dealing with a year or two of very high interest rates. And as I've mentioned, those things are are not going to change when the final votes get tallied up on Friday. Not to say that there aren't some good things that are coming out of it, and there's definitely some good things that come out of being confident, but we're not changing our view of the fact that the economy is going to we're forecasting it's going to be in for a bit of a long, slow grind over the next few quarters. These are numbers that you might want to look at in your own time. The line which I'm always impressed by, though, is if we talk about net core crown debt as a percentage of GDP. So this is what came out of the pre-election fiscal update. So it's Treasury's latest take on the numbers. I love reading some of the conspiracy stuff in the internet about who's writing these numbers. Sorry about the double O at the end of the chart. That's not correct. But you can see the government debt is forecast to be coming back down towards 20% of GDP, which is what that last number should be, over the next few years. And the government returns from a deficit to a surplus over the next few years. Now, National's not proposing to turn these metrics around at any greater pace, really, which is fair enough. But if we think about debt as a percentage of the size of the economy, if we're tracking somewhere in the early 20%, we're comparing ourselves to countries like America, the UK, the Eurozone, where that same metric would be over 100% with no sign of a surplus. So these are world-class numbers. They are enviable, whichever government we're under in terms of the amount of debt. But we are running that big deficit as an economy as a whole. So people will keep a wary eye on the manageability of that amount of debt that the overall economy is running with at the moment. All right, so what does this all mean for inflation and interest rates? Well, inflation's getting better. It's running at 5.6% now. It had peaked at over 7%. But what's still pretty sticky is the non-tradable inflation. If we break inflation into the stuff we either buy or sell offshore that gets its prices set in international markets, like milk, like cars, like fuel. Okay, well, that tradable inflation is still high on a historic basis, but it's coming down. But the non-tradable inflation is still very high, over 6%. So this has got a way to go. What's a big feeder into non-tradable inflation is local wages. So keeping an eye on the labour market like today to see signs of easing wage pressure, I think is really important. And we are seeing things moving in the right direction there. If we've got a low level of unemployment, like 3 to 3.5%, we're going to have a high level of wage growth, which in turn is going to keep that domestic inflation pressure running pretty hot. It's not like the Reserve Bank wants to see the unemployment rate higher and people getting laid off. They just want to see us not slipping into that wage price spiral like we got into in the 70s. So the labour market today, I think, will be pretty welcome from the RBNZ's perspective, but they're going to need to see a lot more easing and pressure both in the labour market and in overall inflation before they get too comfortable and want to start lowering interest rates. So we think that's not a thing that's going to happen in the next 12 months. Just to put some sort of expectations on the length of time, the RBNZ will probably want to be watching this stuff before they think the inflation genie's back in the bottle. What does this mean? Hey, well, great news for term deposit investors. You can get over 6% on a term deposit these days. And that's pretty good, especially when our inflation forecasts are for inflation to come back down. So, for example, our 2-year term deposit forecast of 6%, or that you can lock in now, is higher than our 2-year inflation forecast. Over the 2-year period, we've got inflation getting back down below 3%. So, in other words, you can get a real return on a term deposit now. The flip side of that is we're seeing mortgages track a little bit above average. So mortgages are in that 6.5% to 7.5% range now. I would hope that over the long run, you'll be able to get a mortgage closer to 6%, but not a return back to the levels that we saw prior to the global financial crisis, when we were in the 8 to 10% sort of range, when the Reserve Bank was really trying to lean hard on the economy and inflation. But this is quite interesting in the investment space. When I was working in wealth, one of the things which helped quite a bit was people, when they were getting 1% for a term deposit, would be pretty enthusiastic about looking elsewhere to generate a return. Now, a boring old term deposit's actually providing a pretty attractive return. Likewise, in the commercial property space, some of the returns there were looking pretty skinny, and so we're understandably seeing the yields demanded by investors go up, given that they can get this effectively pretty low risk return from a bank term deposit or a bank bond or a government bond. The incredibly low yields we saw don't really cut it. So price is the thing which needs to move there, and that's what we've been seeing. One of the things we get asked quite a bit is about debt servicing. Is it manageable? We're certainly seeing people roll into mortgages which are right at the around the levels that they were stress tested at. So Reserve Bank talks about that in their financial stability report today. Interestingly, it's not as bad as we saw prior to the global financial crisis. People are carrying a reasonable amount of debt at the moment, but they're servicing it at low interest rates compared to prior to the global financial crisis. So again, if you're interested in the sort of stress about this sort of stuff, and if that impacts your business, then that financial stability report today had some interesting reading about why the Reserve Bank would still regard the overall system as being pretty sound, even though there's clearly some stress and pain with mortgages and borrowing costs going up as much as they have. I won't get bogged down in this, apart from pointing out that my colleague Mark Smith did a lot of research on the cost of living and household expenditure and how we think households survive in this sort of environment. We break it down here into what's grinding people's gears. You can see debt servicing. These light blue boxes are the things which are causing a lot of the increase. This is in dollars per week that houses are spending now compared to a year ago, but it's coming from other areas as well, like fuel, food. It's coming from all angles. So that's something that's available on our website. Again, really important for people with wanting to make thoughts about, well, how do people cope? Where can people cut costs? And how does that impact the sorts of businesses we might invest in? That's what we're trying to do with this sort of research. Finally, with housing, it's interesting. House prices have pulled back about 20% or close to it, but really it's just a continuation of the trend of expensive housing. We think market probably troughed out earlier this year. The migration flows will help support housing, help support rents. The tax changes may at the margins as well, opening up the borders to foreign buyers from a property purchase perspective could help a bit. In terms of prices, if you think prices going up is a good thing. But really, we've got through this COVID period and some changes, and we're just back to having expensive houses. That problem hasn't been solved, and I don't see anything on the horizon that's going to change it around. So we have house prices going up by sort of around the 7% mark next year. We don't get bogged down too much on the accuracy of it, but it's more the direction that we're past the worst and prices can continue to push up from here. And just to end up with a comment on shares before we have a look at some questions. Look, it's been a weak period for share markets, the New Zealand market in particular. We're so interest rate sensitive here, those big gentailers that provide such great dividend yields. Well, they've clearly had a couple of things that have made their prices adjust over the years. we had that weird peak in the New Zealand market when the gentailers went completely nuts due to being included in a clean energy index. And but stripping that aside, we've seen a pretty significant price reduction for those interest rate sensitive stocks, such as the gentailers and other utilities. So our market's down about 6% for the calendar year. This is to 30 September. When we do it to the end of October, which I'll be cutting once the US markets have all closed and the data comes in today. Will be down for the month of October, down around 6% or more for the year to date, and down for the full 12-month period as well. Hand in hand with that, you can see the yield change and the yellow boxes up above. Massive increase in yields. Bond portfolio valuations move in the opposite directions to yields. For yields to be going up, bond prices need to be going down when we mark to market them. So it's been a tough 12 months for diversified portfolios as they struggle on both asset classes. It's unusual to see bonds and shares going down, but not that unusual. We get told about diversification and that the bonds complement the shares and tend to be a counter-cyclical investment. But it's the increase in yields coming through from central banks tightening that's driving the changes in the bond market and driving the weakness in share market. If we actually look at the latest earnings season in the States, which is about halfway through at the moment, the majority of companies, around 75%, are actually beating their earnings estimates. So you'd look at the earnings season so far in the States and say, no, companies are looking pretty reasonable. Yet they're weakening in terms of their share prices. And that's a lot to do with the ongoing uncertainty about where interest rates will end up. We've got the Fed meeting. We've got the Fed meeting today. Tonight, and out early morning tomorrow. The Bank of England, the European Central Bank, they all look like they might be done in terms of tightening. But there's still a bit of concern that maybe they've got more work to do. And of course, we've got the geopolitical uncertainty, which never helps. So a tough. I think it'll turn out to be a pretty tough year for share markets. But nonetheless, the long-term things still hold as to why we'd want to hold both these assets in a portfolio. Hey, so Ben, why don't I stop there and I'll pop the summary up and happy to take any questions over the time we've got left.
Okay, so I've got a handful of questions here, and I'll keep an eye on the main Q&A. So let's bring the system back up. I'll try and ask these in general terms of their topic. So in terms of the migration that we're seeing through, what are your comments about New Zealand's infrastructure and ability to ultimately service those newcomers, both in the transport, health, education sectors?
Look, I think that's a fantastic question, and ultimately, this is the dirty secret, right? If we look at politics over the last 20 years, we have had strong growth. A lot of it's been driven by pretty favourable migration policies, but we haven't had the investment to support the population growth that we've got. And the disappointing thing on my perspective is if I look at Labour and National, I think we're kind of swapping pet projects. If we can in Auckland, say the light rail out towards the airport, but we put in a road that's going to make the east-west connection or some of these other things. They're just swapping billion-dollar projects. But ignoring the overall problem that we've underinvested in infrastructure over a long period of time, and it's just going to get more and more congested with either solution because of the population growth that we've got. And likewise for hospitals, one of the things which really got on my goat over the past few years. The one thing that politicians could agree on was the accord that they're now probably going to walk away from to on densification of housing, three-storied high apartments, houses, for example, without needing to get exceptions. But they couldn't agree that, hey, one of the reasons why we had to have such strict lockdowns is because we don't have the hospital capacity that say was existent in other parts of the world where they could open up a bit earlier. So I think this is the thing that that people, including economists, need to make a bit of noise about. And actually, you look at periods like under both Labor and National, we've had this 20% of GDP target for net government debt. Kind of ironic when we've had a 10-year period where interest rates have been so low that we didn't let that go a little bit higher. Even if they let it go 10% higher to 30%, it's still so low compared to the rest of the world. But we could have got some of this infrastructure in place that we clearly need. So I think this is where we need to treat the government not like a household that should always be trying to pay off debt, but like a business to go, there's nothing wrong with having debt if the quality of the expenditure that debt's going to be used for, or the quality of the projects adds value to the economy. And this is where I think we can do better with better investment in infrastructure. And if that means running a little bit more debt, over the long run, we should be able to do it. It needs households to do a bit of saving, though. Otherwise, we're just going to have that massive current account deficit that we've got at the moment, which starts to have implications for the interest rates we all pay for the currency. But definitely, I think that's a good question and an area where we should be spending more as an economy.
Sticking on a similar topic regarding the GDP, obviously per capita, you're talking about falling, even with the migration coming through. What about productivity? Where are you seeing that?
Yeah, well, that goes hand in hand with it, right? If we were seeing strong productivity growth, we would, and we had a migration surge like this, we'd expect GDP to be much stronger. And ultimately, that's the problem. We haven't had strong productivity growth. We're not dynamic investors. We tend to like buying property. We don't have a dynamic share market. And as a consequence, I think productivity is one of the things which isn't a strong point. Where does that impact households? Well, it's hard to get really decent real wage growth if you don't have productivity growth coming along as well. So that's the bit. And if I look at companies like Fisher and Paykel Healthcare that did so well over COVID, it shows that we can do it here. You can have companies that can go really well and come up with great value-added ideas. If I look at other ones like Fonterra, I think, well, that's not a really good example. We're just still chucking milk powder onto boats and sending it overseas. We're not doing a lot of value add. So those are the things which make me just think, hey, same old, low productivity growth and environment, which isn't great for wages.
So just on the wages for a moment then, so you've talked about inflation coming sort of sub 3% in the next 24 months. Are you seeing most of that fallback coming through non-tradables being wages and the slowdown in wage growth?
Yeah, I mean the slowdown in wage growth really is key, and that's where the migration does come in, right? And I'll use a personal example. If I think about the retirement sector, my mum's passed away now, but she lived in a rest home. She got amazing support, courtesy of migration flows of really quality people coming in, wanting to work in that sector, and it was a better standard of living here in New Zealand than where they came from. So migration does two things. One is it helps a major skill shortage in an important sector, and it also keeps a bit of a lid on the wage growth. But it also adds to pressures on the economy. And I think it's one of those really tricky things when we're looking at migration. We kind of don't want to be a low wage economy. But migration is a key part of us plugging skill gaps. But if we want to be a high wage economy, we need to get more productivity growth. So in turn, as an economy, we either need to accept that foreigners are going to buy our companies and that's how we're going to get the capital inflows, or Kiwis themselves need to be better at savings. And even things like KiwiSaver are a big help on that. We are getting a bit more sophisticated, but gee, it's a long, slow burn when I compare working in funds management in New Zealand compared to Australia.
Yeah, well, the Aussies at least have a salary sacrifice, so they're incentivising funds going into that space. So disappointing we haven't seen anything crop up like that over the years.
Yeah.
Switching tack a little bit, currency. There's been a few questions regarding USD and the NZD.
Yeah.
Have you got any position on that?
Yeah. I mean, I think in the very long run, I think that if the New Zealand economy is going well, I think we're always going to be an exporter of quality food and quality tourist experiences. And if I think, well, what does New Zealand dollar look like if we are selling to the world what they want? To me, it looks like a currency that should be around 70 cents US. Right now, we've got question marks over global growth. We're certainly seeing weak commodity prices. So the New Zealand dollar is actually doing its thing as it's weakening at a time when the New Zealand economic outlook's weakening. How weak does it get? Well, I think we can easily get back down into the 50s, particularly if other economies like the US really do start to slow. I mean, the US has been surprising with how strong it's gone despite the interest rate increases that they've had. But if the US was to start to slow, global growth concerns started to really pick up again, that's the sort of thing that's US dollar positive, commodity currencies like the New Zealand dollar negative, and that's what would drive us lower again. And we've seen some dabs at that with the New Zealand dollar getting down into the 50s, where we've dipped back out into now. So sort of around the 60 with 60 cent mark against the US, easing lower as those global growth concerns and fears pick up. What'll ultimately make it pick up, I think, when the big importers of New Zealand products like China and other Asian economies start to pick up, and we see an improvement in commodity prices. But that seems to be taking longer than what we would have thought, as China just is really slow to get going again, and faces a bunch of problems of their own despite reopening. Property sector case in point. So hey, and in that sense, our forecasts are at the end of this doc. So if we make a PDF and we send it out to people that are attending, they'll be able to see the numbers in there. So and likewise, they're all on our website. So people want to have a close look, that's in there.
Okay, sounds good. Well, just mindful of time, I'll throw one more question at you.
Yep.
You did sort of allude to it through your discussion around inflation falling and interest rates coming down, but I guess currently, when do you see the peak or near peak of interest rates, and what sort of triggers do you think will need to occur before Reserve Bank starts to pull back on those?
Yeah, I think the Reserve Bank's probably very mindful at the moment that there's still a bunch of people that will roll into higher mortgages, and that will keep slowing things. Even if mortgages were static from now on in, and the OCR was static from now on in, there's still more tightening to come. I mean, we've still got people that have got a couple of years to roll on a 299er that they fixed for 5 years, which is just the dream mortgage now, right? But most people fix for 1 to 2 years, and they are rolling into higher rates now as well. They're having their second go at higher rates. So the Reserve Bank's very aware of that, and I think they'll be pretty happy with things staying where they are. The other thing which is going on is if we look at the banks always want to defend their net interest rate margin, so the gap between all the liabilities, which is all our term deposits, all our savings on calls, and all our assets, which are the loans. Those margins they're okay at the moment, but every time you see a term deposit rate going up, that means that the net interest rate margin's getting chipped away. And ASB's been pretty steady for the past month or so, but other banks have been starting to lift rates. That's where the direction of risk lies, because we are still seeing, it's weak credit growth, but we're still seeing credit growth in the economy. And as a consequence, we still need to raise more money in the term deposit space. So that adds some upward pressure to the mortgage as well, even if the OCR stays stable. So what I hope, to answer the question, I hope that sevens are going to be around about where it tops out. You can just get one slightly below it now for committing to sort of that 2 or 3 year term. Not a bad hedge if some of this pressure continues to put a bit more upward pressure on rates, or if indeed the Reserve Bank needs to get cracking again. And I don't see much chance the Reserve Bank's going to be cutting over the next 12 months. So again, I write about that in our home loan report, but the inverted yield curve is a little bit of a help in the sense that people can get certainty, they're cheaper cost at the moment, and if that's particularly useful if the shorter term rates still have a little bit of upward pressure to come. For term deposits, I kind of think they're around their peak at the moment, but we do need that funding. And if the housing market, for example, really started to pick up, we would need to raise more money in the term deposit space to attract and retain funds. So we could be, for a period over the next 6 months, where there's some pretty attractive term deposit rates as well. Eventually, they'll come down, I think, to a sort of around a 4% sort of mark. And mortgages will come down to that 6 to 7% mark, and then you get that around 2% gap that we historically see, that sort of 1 to 2% gap. So, but I think that's what it'll pan out over the next sort of 18 months rather than over the next 6 months, that we'll see some of those changes. High for longer as our sort of hatch line when it comes to mortgages and TDs these days.
Yeah, that's been certainly pretty consistent with what we're seeing. So I think from there we'll probably call it a day. So as per usual, from myself, Grant, Roger, Kerry, and Jack, Chris, thank you very much for taking the time to talk to our clients, and those of you on the call, thank you for joining us. Getting a lot of value out of these sort of lunchtime sessions. So talking about productivity, those of us that are not retired can get back to work and stay away from traffic, and we'll definitely be keen to get you back on and see how things go in the new year.
Excellent. Hey, that sounds great, Ben. And I'll get a PDF through to you with our forecast in this presentation, so you can share it with anyone that's interested. And likewise, fantastic. My email can be shared so people can flip through questions if they want to, or to you and the team, obviously, as well. Brilliant. Thanks a lot.
Thank you very much. Take care.
See you, everyone.